Hello everyone. Mic check 1 2 1 2. Can everyone hear me fine? I hope you can see my screen as well. I'm just starting things up a little bit early, a couple minutes early, just letting people in and giving them a couple minutes to set up. Awesome. I see someone typing. Um, Again, thank you everyone for joining. I appreciate it. You can see my screen as well, I hope. Hello. We have some people from the elite membership also joining. That's great. Thank you everyone for joining, for your support. It's good to be back live. As I give people a couple minutes to get on, the last time I did a YouTube live was last year, I think. Um, I think it was probably mm, over a year ago now, I think. Definitely over a year ago. And then before that, the last time I did them was in March/April of 2020 during the pandemic. And I had just gone through um, just a quick recap of those videos, just take a look. And man, it was hit me right in the feels because it was 2020, March or April, and I remember we were locked down here and I couldn't even get a haircut. So I was laughing because I was looking at the video and my hair was like very long. It was kind of out of control in some way and it was a crazy time. It was a crazy time. And here we are, over 2 years later, and I'm doing one of these again. It's great to be on, and I thank everyone for their support, for getting on, for obviously your time and commitment. I'm just gonna wait another minute until we kick things off. I have a few things I want to talk about. A couple notes here that I have as well on my phone that I'll be referencing, and a couple stats and a couple tweets that I want you to kind of digest. So I hope everyone had a decent day today in markets or otherwise. The markets not the greatest in terms of price action today. I have it on my screen here. The S&P 500 was down about, let's just say, 40 basis points or 0.40% almost. Um, and a pretty tricky day. As I zoom in here, take a look here at the bottom. Look at the candle and the wick there. Pretty volatile day, not a straight flush like we saw on uh, June 9th last week, and same thing with Friday. We saw a straight flush on Friday. Obviously, yesterday was brutal, another brutal day, and then a little bit lower today. So kicking things off again, everyone, thanks for getting on. I don't want to make everyone else wait who, people that have joined on time. So let's kick things off. Market update. First things first, I want to touch on where we are in the market. Here we are with the S&P 500. So the S&P 500 is the index that I always refer pretty much 95% to 99% of the time. Either that or it's the Nasdaq. All right. I don't personally reference the Dow. I think it's a bit obtuse for multiple reasons, but the S&P 500 is my go-to as the index, the benchmark to measure the broader U.S. market. Okay, and first a few stats for you. So first thing first, from the close of the highs to today's close, the S&P 500 is now down 22%. All right, roughly 22% year to date. What does that mean? That means we're officially in a bear market. Okay, for those of you that traded through 2020, COVID crash, you should have an idea what a bear market is, or maybe you haven't gone through a bear market yourself, but anything higher than a 20% drop from the peak, that's known as a bear market. And it doesn't necessarily mean a crash. A crash is something else, and it's a little bit more vague. All right. So now that we're officially in bear market territory, where do we go from here? I have drawn this bright red line here that you can see. And what does this tell you? This is somewhat of a key level. The members in elite membership know that it's a key level. It's a level that I am kind of waiting to see if we can breach below before I make any further changes to my portfolio in terms of adding to stocks I already own or buying other great companies. All right, so this key level is very important. If we go lower than that, I wouldn't be surprised if we do go lower. But at this point, we want to kind of keep an eye. I'm not here to make wild predictions and wild projections, although I will share a few tidbits with you. Continuing on, the S&P 500 right now, 37.35. So keep an eye on that. Tomorrow, we also know is the Fed rate decision day. And there's a lot of talk about, are they going to raise rates by 50 basis points, so 0.50%, or are they going to raise them by more, maybe 0.75%? I think it's like 90% or so prediction that the Fed will raise 75 basis points tomorrow, simply because the most recent inflation print that came out last Friday was brutal. I think about 8.6%. That means even after the current rate hikes we've had, it's not impacting inflation in a downward manner like they would like, right? We can't sustain an 8% or 9% or higher inflation rate, period. Right? I'm seeing a message, your audio is a bit weak. I hope it's a bit better now. But ultimately, moving the mic up here, we won't know for sure until 2 p.m. Eastern time. That's when the rate decision comes out. After that, at 2:30 or so is when we're going to see, the Fed minutes. We're going to see some chatter and talk from Powell about the decision and what's to come in the future. All right. Now, in terms of some stats, I'm gonna talk to you about a post that I did on Twitter the other day, and that is pertaining to inflation rates, and of course something in regards to central banks. I posted this in November of 2021, and you could see on the timestamp date here. And I said, look, the central banks are behind the curve. Okay, so this is something I've been saying on social media for a better part of the year. But this is a tweet from November, and I said, look, we are in an environment where inflation needs to go up. We need to see the Fed start doing something. But no, they're not. They're just kicking the ball down the road instead of doing what they need to, which is start raising rates. And I will remind you that they didn't start raising rates till April this year. Okay, so that's one example. Another example I can give you is on December 15th. I said in response to someone, I said, look, in the end, I'm a nobody, right? I'm not in the Fed. I'm not a politician. I'm not, in these circles. But I've been saying it since Q1, right? That inflation is completely out of control. The Fed needs to react, right? And they're going to have to start playing catch up because they're far behind the curve. And lo and behold, I said in April, tomorrow's inflation print will be very high. I said the Fed will be forced to do a hard landing. What does that mean? That means, the Fed is forced to raise rates faster than they would like. Ideally they want to raise rates 25 basis points, take things slow, not to freak or panic the market, not to crush the economy. But guess what? They were asleep at the wheel. They didn't do anything for the longest time, and now all of a sudden they're playing catch up, and I'll expand on that a bit. And this tweet here is actually from Stanley Druckenmiller, and he said, he said that once inflation is greater than 50%, and for a sustained period of time, or greater than 5%, for a sustained period of time, it doesn't come down, okay, until the benchmark interest rates are higher than inflation. So right now, let's say with benchmark interest rates, I think a percent, 1.75%. Real rates are still negative. Real rates means benchmark rates minus inflation. Okay, it's a negative number. And what happens then? You have to increase inflation above and interest rates above and beyond inflation to be able to combat inflation. Right now, the Fed is way, 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 way off the mark, right? So another important stat that Stan says is once inflation is greater than 5% and has stayed there, which has, it's never tamed without a recession. Okay, so this is why it's very important to share this with you. It's very important to add some color to this, to give you guys some perspective. And this is why I thought, you know what, I should do this webinar, share this, talk about this, and provide some context, right? So right now, if we scroll out, you will see here in the middle of the screen the COVID crash, okay? And that was the fastest drop in the history of the financial markets. And let's see, that was approximately 33% or so from the highs. And that was the fastest drop any of us have ever seen. But it was also the fastest recovery. So if we continue from the highs right here, okay, from before the COVID crash to where the all-time highs was, the market recovered in a span of, let's just say, a year and a half, went up 42%, okay, above and beyond the previous high before COVID. If we count where the market went, how much it went up till January 2022, it went up 100%. It doubled from the bottom of the COVID drop, a little bit more, in fact, 110% or so. So you can see the enormous rally we've had. So a pullback of 20% doesn't mean that, okay, this is it, this is the bottom, right? And I've said that a long time. We in Elite especially, we've bought these kind of rallies, hopefully sold down, averaged, and we still have some positions. I still have some positions myself that I'm holding, and they're great companies. They're fantastic companies. Yeah, they're in the red, but it doesn't matter because I'm not looking to time the entry perfectly. I'm not day trading them. In fact, some of them I'm not even looking to swing trade. I'm looking to hold. And if I make some money or if they're doing well, then I'll adjust. But for the time being, any solid company that I'm in the red, I am looking to strategically hold and then decide if I want to maybe scale in. And because I don't always, most often I don't go all in ever in a trade. All in meaning a full position size. I usually maybe take a quarter or maybe 1/3 of a position or maybe half a position and then scale in from there. So that's something you want to think about if you aren't doing that. Now here comes the fun part. I have some notes for you that I want to get into, and here's a stat. Okay, here's a stat for you from Bank of America. This is the 20th bear market in the last 140 years. Okay, so that tells you, look, bear markets aren't unheard of. They happen, not every year, but they happen every few years. So this is the 20th one. The average peak, okay, to trough bear decline is on average 37.3%. So where does this leave us? All right. I told you, if you were here at the start of the webinar, to the live, that we are down about 22% from the high. All right. These aren't exact metrics, but you get the point. To get to a 33 or 34%, 37% drop from the high would bring us down to the 3,000 level. Okay, again, don't let the stat from Bank of America fool you just yet. This is the average drop. In 2008, we had a larger drop, maybe around 45% or so in the index. In 2020, for COVID, we had about a 35% drop. So this is what we're looking at. If we see a pullback even further, okay, the S&P 500 breaks below 3,700, goes down to 3,000 level, where does this bring us? This brings us to June 2020. All right, June 2020. That is, to give you some perspective, approximately, okay, right now, about, if it were to happen tomorrow, it's not going to happen tomorrow, but if it were to happen tomorrow, that would be approximately 2 years worth of gains wiped out in the index. All right. So that's something to keep in mind. Now, again, one last stat from Bank of America. We know 3,000 would be that kind of level. All right. But another quick thing, on average, okay, a bear market duration, again, average is 289 days. Okay. So right now, we what feels like forever, we are not in the tail end of it yet, based on historical statistics. All right. And based on this average number of 289 days, this means that potentially, again, based on historical precedent, we could see this bear market continue until October. Okay. So this is why I thought I'd come on and give you guys some mind-blowing insights. Okay. Specifically October 19th. So save this, timestamp this. Okay. Here's what we're looking at in terms of a drop. All right. One sec. Sorry. From here to 3,000 on October 19th. All right. So here we are. From where we are now, about 3730 or so, down to 3,000. All right. Represents another 20% drop, another 718 points of the S&P 500, and in approximately another 124 days. Okay. Again, it's not specific exact, but all right, at least you get the point. All right. This is something that I thought would be very interesting for you guys. And with that out of the way, I want to get into really what I think and what I feel about the Fed. And this is going to be pretty blunt. It's going to be pretty on the nose. I'm not going to be holding anything back. And maybe you'll agree with, maybe you don't. And it might be a little bit of profanity. So if you are sensitive to that, you might want to be aware. But ultimately, in regards to inflation, in regards to the Fed, I will say this, that, the Fed has thousands and thousands of economists on their payroll. They're costing taxpayers billions of dollars each and every year. And guess what? All these Fed officials, okay? Remember, the Federal Reserve, Jerome Powell is the chair. He's the kind of like the leader, the head honcho. But there are other Fed officials from different states, yada, yada. And pretty much all they do is, look at all the white papers and all the reports from their underlings, from all these economists that work for them and for the Fed. And then they just, present their theses, present their thoughts to each other. Okay? It's like a big circle jerk at this point. So despite this, okay, they didn't realize that after trillions of dollars in money printing, that it would create inflation. In March, up until this March, okay, March 2022, they were doing quantitative easing, which is what? QE. QE means they're buying assets. The Fed has been buying trillions of dollars worth of assets, like bonds, treasury bonds, corporate bonds, for years now. And they continue to do that. They continue to inject liquidity into the economy, into corporations, so on and so forth, into lending, right? And because these morons has never been to a grocery store, it seems like, they never filled up their own cars, they had no idea that inflation is running rampant. It seems like, they're just sitting in their ivory towers and, these fat cats just completely disconnected from reality. It's a shame because these schmucks, use backwards looking data. They use data that's corrupt. It's pretty much, dated. It's stale, right? We refer to this as stale data, which by the time it comes out, it's already outdated. So they go based on this data that's very, very stale. And ultimately what happens? You get the saying, garbage in, garbage out, right? And these complete buffoons. All they've been doing is watching inflation spin out of control and giving us the line, oh, okay, it's transitory. It's transitory, despite having thousands of people on their payroll, right, tracking these things. Then, eventually, Congress, okay, which is full of a bunch of morons, again, and they don't fill up their cars. They don't apparently do their own fucking groceries because they were also clueless as fuck. But eventually they catch on, okay? They catch on eventually, and they say, okay, well, inflation's out of control. So what does the Fed do then? Then they're like, oh, okay, we got to do something. We're caught off guard, right? Oh, we didn't know this was not transitory. Oh, we didn't know this was here to stay. We didn't know, the average person is getting squeezed, because these fuckers are not average people. They're sit there, doing diddly squat and collecting their salary, and then, trading on information and making investments based on information only they have. Okay, it blows my mind. Okay. Now what do they do? They're like, oh, we got to do something. We're getting paid all this money. People are looking at us. The politicians are, breathing down our neck. We got to do something. We got to do something. Oh, okay. So what do we do? Ramp this baby up. Let's start now raising rates. So these fuckers were doing nothing. An idiot like me, a nobody like me in the grand scheme of things, had been saying since Q1, this is fucked up. This ain't right. I get it. We needed some... we needed some cash injection. People needed some money because, none of us have lived through a pandemic. No politician now, maybe because some of them are 200 years old, but some of them maybe have lived through a pandemic. But the vast 99.9% of us have not lived through a pandemic. We haven't gone through a pandemic. We don't really have a blueprint or best practices or what to do, in this environment. So what do? They did the easy thing. Give everyone, a few $1,000, maybe give them some more, easy credit, no interest rates, give them some loans, make them happy, appease them, not realizing, the average person doesn't know, but not realizing that they're taking a few $1,000s from, the government, and they're being essentially like a baby. You give them like, a piece of candy, or you give them a phone and say, okay, shut up and just sit there, right? Until now. And now the public has woken up, and everyone's woken up. Everyone's pissed off. Everyone's like, what is going on? What is this? And what we learned by this is that the people in charge, they're not any smarter than you and me. They're fucking PhDs and their Harvard degrees and their Yale, freaking board seats and all that. They don't do anything. They don't know anything. And this proves it. The last 2 years has been eye-opening for everyone. I always had a feeling, but I had some hope. I had some faith in the institutions. I had faith in, our leaders to an extent. But over the last couple of years, I haven't. It's been very depressing. So what do? They start ramping up rates, and guess what? We have seen the fastest rate hike process or rate hike cycle in North America. Okay, the Europe is another clusterfuck. But anyways, that's another story. But this is the fastest rate hike cycle in North America, Canada, and U.S. We have seen in decades. So the average person is not only getting completely wrecked because of inflation, and whether it's priced at the pumps, whether it's being priced out of housing, whether it's insane rents, whether it's crazy high grocery bills, whatever, right? Now their cost of borrowing has gone up. Now, even if they did want to borrow, take on new debt, that's a lot higher to borrow. Costs are a lot higher than it was before, and many of them may not even qualify. So now we're in a situation where this brings us to tomorrow. People are like, Riz, what are they going to do? Is it 50 basis points? Is it 75 basis points? So is it, 0.5%, or is it 0.75%? And I'm like, at this point, it doesn't even fucking matter anymore, because they're literally 8% behind the curve, meaning the benchmark rates should be around 8% if inflation is where it is. If you want to combat inflation based on historicals, they need to be around 8%, which is really messed up because we haven't had 8% benchmark rates. Remember, not, mortgage rates. Mortgage rates are about 6% right now, and the benchmark rates is about not even 2%. So imagine what's going to happen with with mortgage rates. Imagine what's going to happen with car loans. So this is the situation. This is the stuff that keeps me up at night. Not because the stock market's down 20% and I'm down, a few 100,000 or whatever. Like it's not a big deal to me personally. I get it hurts. I understand. I'm not happy, being down a few hundred grand, and seeing my portfolio down 5-6 figures in a day. But guess what? We are here because of the Federal Reserve. And I'll make one last note. All right. This is not the first time these fucking idiots have done this. Okay. I have been around markets. I've gone through a bear market, but I was very young. This was 2008. I had just getting started. This is not something that, I was completely proficient or knew what the hell was going on. I didn't even know what the Fed was, when I first started. Completely green at 16 years old in 2008. And I remember that was a very different market. But you don't have to look far to realize that what they do is anytime the market's going up, they, what do? Okay, they scale out. They pull back the money printing. They pull back on the quantitative easing. Then what do? Once markets start dropping, the economy starts slowing down, then they go to the other extreme. Then they ramp up so fast because we're asleep at the wheel. They didn't realize, what the fuck, inflation exists, right? It's going from 2% to 4% to 5% to 6%, 6% to 8%. It's not transitory. What? Right? So these people are completely asleep at the wheel, and I think they cause more damage than anything. The Federal Reserve was created to not for the stock market. It was created to stabilize the economic cycle. So we don't have booms and bubbles and busts and complete wipeouts. They're there to smooth out the curve, right? So to speak. They're there so that we can keep the economy from going red hot and ice cold, right? But somewhere in between. Because recessions are a healthy part of the economy. Economic growth is a healthy part. Some stagnation and sideways moving is a healthy part. But 8% inflation is not a healthy part. Massive amounts of quantitative easing is not a healthy part. These people reacting so late and then having to play catch up by raising rates so fast that now they risk either, crashing and tanking the economy and the stock market as a result. Or if they don't do enough and do it fast enough, we have situations like now where even after a few rate hikes, we're still seeing interest rates, above 8.5%. So this is the problem. The Fed has lost credibility some time ago. For me, they lost credibility years ago, but for the average person, they've lost credibility. That's why the market is really not really caring about whether they do 50 basis point rate hikes or even 75% basis point hikes. I did it 0.75%. The market doesn't care. Who is controlling by proxy is the commodities and oil giants. These are the companies that are in play, and how much supply they have, their pricing is dictating inflation. So we've seen the number one factor of inflation, the number one part of high inflation. It's not the only one, but the highest weighting for that is oil prices, and of course price at the pump. That's what's really waking people up. People really had to fill up gas and then see like, holy crap, this is costing me an arm and a leg, only then to realize that, okay, this is wrong. It's only then that people have been complaining now, right? Otherwise, the last 6 to 8 months, people have been asleep. The average person, right? I've been talking about it for too long, unfortunately. But you know what? This is the situation. This is where we are. And I thought, it makes sense to put my thoughts, give you guys a little bit of a game plan, what to do in terms of where the market is, where it's been, and where we might go. I think there's still more downside. Doesn't mean I'm panic selling. Doesn't mean I'm selling everything and we're gonna have a crash no matter what, or the S&P 500 is gonna go to 3,000 no matter what. No, again, we are looking at those stats that I gave, those numbers that I gave from Bank of America. They are essentially looking at prior historical bear markets and really drawing some general conclusions from that, right? So it does give you an idea. Okay, this area is key. I hope this is giving you a little bit more clarity and insights and open your eyes as to really what's been going on with the Fed, why we are in the situation that we are, the negative impacts of massive amounts of money printing, massive amounts of capital being forced into the system. And as a result, you have the Federal Reserve that, has lost the plot. They caused more damage, I think, than good. And, after studying the market, historical years, 2000s and even earlier, I can tell you that the Federal Reserve has had a big part in this. And, there's nothing you or I could do about it besides being self-aware and being aware of these circumstances and then reacting accordingly, aligning ourselves and positioning ourselves accordingly. So tomorrow's a big day for the rate decision, so I thought it'd be a good idea to do this tonight. And of course, with that said, I want to open it up. I don't want to drag this too long, so I do want to open things up to questions, any questions you may have. So you have the chat bar there. Feel free to type some questions in. I'll do my best to go through pretty much every question that I can, time permitting, and we will, cap things off. All right, so I'm just gonna wait a minute till questions come in, but ultimately here we are. This is the situation. I'm also going to bring up the VIX for you here. The VIX is the volatility index. The VIX actually is down 4%. A little bit red today, but not the end of the world. You can see compared to 2020, where the VIX just completely went bonkers. I don't think that's going to happen this time around to that level that fast, simply because we're not getting a complete elevator down like we did in 2020, right? We aren't getting that huge, colossal meltdown like we did in 2020 of March and April. So the VIX can continue higher, but I feel like we're not in a situation where we see it go all the way to 80 or 85. All right. So I have a question coming here. Do I think if war in Ukraine stops, do we get a break? So this is a good question here, something I've talked about for a bit. If the war in Ukraine does stop, if we see, just tomorrow, Vladimir Putin's like, yeah, I'm done. He runs back and calls it off with tail between his legs. What happens then? So I can tell you for certainty, two things will happen. One, oil will drop, and it will drop significantly. So we could very easily see, oil come down, not really surprising, easily to the $100 area. Okay, so we could see oil drop, lose about 15 to 20%, all right, roughly to $100. It's still messed up. It's still very high, but it's definitely better than 120. Okay, that's number one. We may also see, it's going to take time. That one's going to take time, where we might see some supply constraints, some of the constraints around wheat and some commodities essentially ease off, because Ukraine and Russia as well provide a decent amount of foodstuffs, right? So we would see that ease off a bit. As far as the market being like, oh, okay, great, we're not in bear market anymore. It might be a temporary little relief rally, but I don't think that's really going to change the broader narrative and situation that we're in, which is out of control inflation, some supply side slowdowns, wage inflation is very high. We've seen layoffs already start happening. We've seen, job cuts already happening. We've seen hiring freeze also happen, primarily in tech, but this is how it starts, right? So something to consider. Another question I have is, in my opinion, what would change market sentiment to bullish views? Is it mostly inflation? If so, it would be a while until markets come back to bullish. Is correct. Yeah. So this is a slow game, unfortunately. We're in a very slow moving um, data set. So, we're not seeing inflation print come every week. We're going to have to wait till next print, a few weeks down the line. And even that is a bit delayed. So really we're kind of stuck, and I don't see inflation going from 8%, 8.5%, if it does come down anytime soon, to like all of a sudden 6%. It's not going to happen like that. It's going to be a slow grind. And once the market sees that, then yes, then we could potentially be in the clear. And that's why I say, although the extreme case statistically from, on averages is 3,000 level, approximately a 37% drop from peak, from all-time highs, that doesn't mean that's going to happen or that has to happen before we see an uptick. No, we could easily, see in the next few months that, maybe inflation, starts easing back. And the market doesn't need inflation to come back to 3% to start, recovering. It just needs the trajectory, just needs the curve to change course. It needs to stop going up, and staying up there and start easing and rolling over. Okay, that's what the market wants to see. And then what will happen is it wants to be assured that the Fed is, maybe in some odd chance knows what the fuck they're doing. Right now we haven't gotten that kind of confidence, but that remains to be seen. All right, another question. There's an issue now between Israel and Lebanon about gas fields. This is this is something that's, anytime we see a problem, anytime we see a problem with supply in oil, anytime we see oil refineries turn off, whether it's in the Middle East or anywhere, or down south, this can make an impact on supply, right? It can have a negative impact on supply. I don't think it's a big deal, to be honest, in regards to in the grand scheme of things. So another question by Dan. So even though the Fed raises rates tomorrow, let's say by 75 basis points, the market and stocks in general won't go down even deeper. Yeah, so they can, they can. What is? But I feel like if the Fed does a 50 basis point hike, and again, it's not just the hike numbers. They're not just, market isn't just looking at is it 50 or 75. The market wants to know what the Fed has to say, what Jerome Powell has to say for himself. The last time we got the 50 basis point rate hike, Powell said, "Oh, we're not planning on 75 basis points." And I remember the market was puking because it was like, "Oh my God, maybe we need a 75 basis point hike." And this guy was like, "No, we're not planning any 75 basis point rate hike." So if tomorrow if we see a 50 basis point rate hike, and Powell stays true to his words, I think the market can go lower, because that means the Fed's seeing the writing on the wall and they're still not reacting, right? So the market, I think, wants to see a 75 basis point rate hike more than a 50. And that's kind of counterintuitive. That's kind of makes no sense, right? But it does, because this tells the market that, okay, the Fed is willing to react faster, willing to start taking inflation seriously, because they haven't until, April or, this year, which isn't that long, right? So now they're taking things seriously. Now they're accelerating rate hikes, which isn't ideal for the economy. It isn't ideal for the stock market. It isn't ideal for the average person. But inflation is an even worse circumstance. So you're kind of stuck in between a rock and a hard place. And again, like I said, this is where we are. People thought you can print trillions of dollars, you can put massive amounts of money in the system, you can give handouts, you can, do all these things, and you just get away with it. No, it's something's got to give, right? So here we are. The housing market's going to collapse if they raise it any faster. So the housing market is a precarious one here. I'll go on record and say this. I am personally not a net buyer of physical real estate. I haven't been since 2019. I haven't bought any new real estate properties or anything since 2019. I had considered it 2020, early 2020, when we saw a big slowdown, in the first few months of COVID. Then it just went crazy, and on the upside. So I haven't bought anything. Now, in regards to where we go from here, I personally think there's more downside. I think there's more downside. I wouldn't be surprised if we see, I'm not saying we're gonna see a 2008 like housing collapse or crash again. As much as these these talking heads on social media and TV want you to scare the living lights out of you, I don't think we see that this time around. I think we can see pull back in pricing. So we're already seeing a decrease in buying pressure. We're seeing a decrease in bidding. We're seeing a decrease in house viewings. We're seeing a decrease in sales. We're seeing a decrease in mortgage, applications. So that means less people are applying for mortgages. Less people are changing homes. Less people are, buying. So what this means is we could see a cool down in housing, and I think maybe we see a 10 to 20% drop in average pricing. Again, that's, I think, a pretty serious case. It's still pretty substantial, but that's not the end of the world when you think about it. Some of the housing prices, depending on where you stay, were going up 10, 20, even 30% a year in the last couple of years. So it's not all that bad. If someone bought their home pre-2019, whether it's the principal residence or whether it's an investment property, they should be sitting pretty good, even if we see a 20% drop. It's the people that bought this year, last year, and maybe near the tail end or middle of 2020, they could find themselves in a bit of trouble in the years to come, because it depends also on their mortgage rates. I personally don't have a mortgage. I don't have any debts. So for me, it doesn't. If I don't give two shits, right? But for people that do have a mortgage on their home or their investment property, and it comes time for renewal, they could be in a bit of a pinch, right? Especially if they have a variable rate. That's a big problem where I am here in Canada. A large majority of people that got mortgages in the last 2 years went with variable mortgage rates because the Canadian Central Bank is on record as saying that we don't anticipate raising rates till 2023. And here we are in 2022, and they've already done 2 or 3 rate hikes. In fact, Canada was first to do a rate hike and also first to do a 50 basis point rate hike before the U.S. So the Canadian housing market is slowed down. It's not tanked or anything, but it's slowed down, and the average Canadian consumer is also getting significantly squeezed because the Canadian economy is a fraction of what the U.S.'s economy is. All right. So continuing on, do you think people lose their homes once renewal time comes? No, I don't think we're in that kind of situation. We're not in a 2008 situation. At least I don't think. I hope I'm right, because I don't think anyone wants to go through that. No matter how much you want, to buy the dip or whatever. I don't think that's good for anyone because that's too much of an extreme. So I don't see people like, being forced out of their homes or, getting, the foreclosures going up. Like, I don't see anything like that. It can happen. We've seen credit card debt go up. We've seen a crunch so far, but I don't think we see that like in a massive scale like we saw in 2008 and 2009. All right, but I do see housing, instead of going like this, kind of slowing down, maybe trickling down, and it sure as hell isn't going up like it's, on fucking jet fuel. All right. So it's something to consider. With that said, any final questions? It's been a great session, some solid questions so far. Again, I appreciate everyone coming out. I appreciate your support. Again, please don't forget, if you haven't yet, subscribe, share our content, like the video, comment. It helps a lot. There's a bunch of clowns and idiots and a bunch of babbling morons out there. Hell, we have the Federal Reserve who's completely fucking clueless. It's not that unimaginable to see idiots on TikTok and Instagram and Twitter just yapping away with no experience, no idea what the fuck they're talking about, and leading many people astray, unfortunately, right? So, please do me a favor, if you can, like, subscribe, share our content. It means a lot, whether it's Instagram, YouTube, everything a little bit helps. All right, I appreciate that. Thank you so much. And someone asks, what do I think about when am I going to be opening up the elite membership? The elite membership is closed to new members, and I'm anticipating opening it up again for the next round, probably August sometime. So stay tuned for that. I'll give some advance warning. Letting people know that okay, we're opening up. So like I usually do. So when that time comes, absolutely take the opportunity to join, because it's a fantastic community. It's an amazing community. I can't even explain to you how awesome it is, and all the kind of amazing content we have, and all the amazing people. All right, so here's a quick question actually that I find interesting. I'm a car guy, so there's one question that I have here by Sunny, and he says, "What do you think about the used car market?" This is interesting because it's in my wheelhouse. The used car market in the U.S. has been going down as well. It's pulling back after. It's crazy. It's crazy, just like the housing market and pretty much anything, whether it's watches, bags, houses, cars, fucking you name it. It was going nuts. Pricing is nuts. It's crazy, right? And that's been an indication of cheap money, cheap credit, massive amounts of money pumping. People didn't want to go to work, right? Because they're too busy fucking trying to gamble on Dogecoin and whatever the fuck else is out there, right? They're too busy, collecting government checks or whatever. They don't have an incentive to go back. No one wants to really work and work a hard job, when they don't need to. So that's all coming to a heed now. I think U.S. Used car prices are coming down. I think obviously there's a lot more downside. I'm not really buying anything, expensive anytime soon or this year. I'm in Canada, so it really doesn't make sense to buy, unless the season's coming up. Otherwise, my cars would just sit 6 to 8 months of the year in the garage. So, that's my 2 cents. But I think used car markets has some room to go down significantly. Someone asked me if I reached out to the kid who bought my McLaren. No, I didn't. I didn't want to be heavy-handed, so I didn't message him yesterday. But maybe in the next few days, I'll message him asking him how things are going. And I don't want to be obnoxious. I don't want to rub him the wrong way. But maybe see what he's doing. I know he has a few cars. Let's see. I didn't want to message yesterday because yesterday was brutal for not just crypto. Obviously, stocks are down too. So I'm not trying to be chauvinistic or full of myself. But ultimately, it's painful, especially for people in crypto. And very much like him, I remember him telling me that he was all in on crypto, didn't have any stocks or other investments. He just had crypto. So hopefully diversified, like I told him last year. So let's see how things go. Again, it's been great. Again, everyone, thanks for joining. Really appreciate it. Hopefully you got something out of it. Enjoyed the content, and we'll stay in touch. And have a great rest of the day. Fingers crossed for tomorrow. Let's see how it goes. Pretty much a toss-up now in regards to what the Fed does and how the market reacts. That's why I've been kind of staying put, not doing too much in the markets the last few days and even last week. So again, let's see how this goes, and I'll update you guys on social media, Instagram, so on, with things happening as they happen. All right. Thanks a lot. Take care. Ciao.